Okay, so this is Magdalene from Itus Capital. I welcome you for the first quarter investor call 2022 on behalf of Itus Capital. And at this time, I'd like to thank all of you for taking the time to be a part of this call. I hope you all are doing well and are safe. So before we move into the major part of the call, where Naveen would walk us through the latest trends and portfolio positioning in our quarterly call, I'd like to keep all my participants informed that all our participants will be in a listen-only mode. After a presentation by our founder and fund manager, Naveen Chandramohan, we will have the Q&A session. From here on, I would request Naveen to take over and do us a presentation.
Thanks, Magdalene, for this. So I wanted to thank everyone who could make time out to come and attend this call. Obviously, to start this positive note, we at Itus have been traveling for a part of 1 year now. So I don't think restrictions really place too much of a barrier for us to travel. But over the last 9 months, what I can positively tell you is while it's not great for travel, but the queue has been increasing in the airports. The taxis are buzzing as far as transit is concerned. The traffic in terms of every city that Chennai, Delhi, Bangalore, Hyderabad, it's gotten worse. Hotel bookings are a lot harder to do. So for most part, I think the economy as well as the infrastructure has opened up and things have normalized, right? So on that positive note, through our call today, I would be keen to cover our performance. Clearly, that's how investors like yourself are going to measure us. Our strategy as to what should you as investors continue to expect at Itus. And finally, how one should treat portfolio construction at Itus and deployment at Itus, alongside how macro events affect us and or at least how we think about them. So for people who attended our December 2021 call, so we left investors with a few broad takeaways, and I just wanted to summarize that. Our cash flow growth from the deck quarter earnings. So we just entering the March quarter earnings season as we speak. So we still have a reference to the previous quarter earnings. So our cash flow growth at a portfolio level was robust, continues to be robust at north of 22%, with the reinvestment rate north of 20%, both of which are extremely healthy as far as portfolio metrics is concerned. From a geography perspective, India continues to be the best positioned market for growth. Why do I say that? Obviously, with the home of capital markets continues to be the US, and with us coming out of a 10-year bull run, it's important. Liquidity is going to get taken out over the next 1.5 years. Are going to get reduced. There is a potential possibility of noise of interest rates going up in a significant way. When I say significant, to put it into context, over 200 basis points over the next 1.5 years, and the Fed is in a difficult spot. So valuations are more than aptly justified. China has its own set of troubles, considering whatever happened with COVID and the supply chain distortions with war. So if you are a domestic investor or a FII, you cannot ignore India anymore, right? So most of the investors on this call today own global portfolios. So it's important to understand, why do I talk about global risk today? At Itus, we will continue to deploy as far as opportunities in the market present itself. What does that mean? We are looking at individual companies rather than talking about the market at large. As long as we focus on valuations and buy growth without overpaying for them, our portfolios will continue to do well over a 3-year cycle. And I'll take you through what I mean by that. So this is a brief overview of what I would like to cover on this call before we open it up for Q&A. We'll talk through our performance. I'll give you a brief update on the strategy. We'll talk about what market rotation we are seeing on the ground and what it means to us, and finally end it with the trends and narratives that we see on the ground. So it's important to understand what we are building at Itus as an asset management firm. For us as portfolio managers, when we construct our portfolio, it is with a long-term horizon. Now, how do we define this long-term? Because it's important for you as investors to understand that. We aim to beat the market through a healthy outperformance over 3-year cycles. Because every time we do it over the rolling 3 years, we continue to deliver value to our investors. While as investors, you want to look at performance at regular intervals, be it daily or monthly or quarterly, we as managers want to look at the health of the portfolio over the same intervals. And it's important to understand there will always be dichotomy between the two, as the markets are never efficient. So as investors, you're looking at the price. As fund managers, we are looking at the health, and they normally always don't merge over the short term. So for us, the health of our portfolio, when I talk about it, is always monitored from a cash flow growth perspective, along with the reinvestment style. Secondly, what we care about is the management's ability to reinvest in the companies that we are investing in. And if they are not able to reinvest that, we expect them to pay it out as dividends to us. So I just wanted to lay out this context before I then look at what have we done from a fund perspective against Nifty over the last 5.5 years since inception of the fund. A quick note on why I compare ourselves with Nifty, though we are a multi-cap fund. It's important to realize when you break down 20 years of return in India, right, into 5-year intervals or even into 3-year intervals, because I'm defining here as the Nifty continues to be performing index with the lowest drawdowns. What do I mean by that? You have Nifty, which is your large cap index, you have your mid index, and you have your small cap index. Over short periods of time, be it 1 year, 1.5 years, your mid and small cap can outperform significantly. The moment you take it to 3 or 5 years, Nifty continues to be the most consistent index, which is what we measure through volatility mid and small cap index. So for us as portfolio managers, we want to be benchmarking ourselves to the most consistent index rather than saying that there is another index out there which is more volatile and show that our returns are a lot better than that. So that's the reason we continue to benchmark ourselves with versus Nifty. So 2022, the first quarter, we are there is a negative 2.2% on the fund, 2.7% on the fund. So we've underperformed Nifty, which I'll cover by around 3%. But in terms of our portfolio performance since inception, we continue to beat the index by a healthy 84% outperformance. And we've continued to do that on a rolling 3-year return basis, which I'll cover, right? So it's important for investors to understand, will we do it every year? While that's the aim, it's always going to be hard to do it every year. There would be periods of underperformance, and I'll walk you through why that happens and how do we think about it. So the reason I asked you to think about ITIS and the way we think about portfolios from a 3-year perspective is because over 3 years, it's a good enough period to evaluate a certain cycle. Now, we've run this fund for a little over 5 years now. So let's take rolling returns. The reason I take rolling returns is it basically annuls the aspect of when an investor joins us. So assume that an investor joined us in 2017, right? The rolling average 3-year returns of the fund was at 68% against Nifty at 48%. The same investor, if he had joined us in 2018, again would have seen a healthy outperformance against Nifty. And if an investor again joined us in 2019, the outperformance was much more starker. So what I'm trying to put across the table is when you continue to monitor us from short-term returns perspective, focusing on 3 years, giving a fund 3 years, at least ITIS 3 years, ensures performance across cycles. It also ensures a higher probability of returns as normalization of cash flow growth to the actual IRR that the portfolio expects should happen over time. Now, I always say this, if every CEO was to be measured on their decisions that they take on a quarterly basis, which is what analysts do. Unfortunately, we would not have any CEO whose tenure lasts beyond 6 months, right? So for the management to be doing their job, it's important to understand the average tenure of a CEO in India is still 3 years. So the average cycle for an economic upturn or a downturn where you see one also happens to be 3 years. And that's why I keep going into a 3-year horizon for normalization between what we care about from a cash flow growth perspective versus what you look at from an investor returns perspective. So zooming out, right? So first I wanted to give you a zoomed in perspective of where we are in terms of returns. Now, if I zoom out, our outperformance has been significant. We continue to outperform around 8% on an IR. It's always hard to zoom out because it's imperative to understand and measure performance from over slightly longer periods of time. It's also important to understand how we are doing on a short term and what we are looking at from a short term basis, which is what I'll cover through the rest of the presentation. So attribution analysis is an important aspect of how are we doing at any given point of time, right? Where are our top 5 gainers? Where are our top 5 detractors, right? So obviously at any point of time, you are measuring both and trying to see if the detractors are cause of concern or what are the gainers actually doing for them to continue to remain in our portfolio. So I'll just quickly go over some of the businesses that have done well and some of the businesses that have detracted the portfolio returns in the last quarter, because I'm measuring 2022 returns with Jan to March as the period when I do this attribution analysis. So Ahluwalia Contracts is a construction company. It's transitioned from being a contractor for residential real estate, let's call it 8 years back, where it went to a fair amount of trouble, into a contractor which is predominantly doing medical hospitals today, which is where the government's focus is, right? What does that meant from a cash flow perspective and a balance sheet perspective? Over the last 3 years, the cash flow growth is almost tripled. The working capital cycle, which is basically how long it is efficiently taken for it to collect cash, because it's extremely important for a contracting company to do that, is reduced from almost 180 days 4 years back to almost 60 days, which is where it is today. The order book is extremely robust, and we continue to be optimistic on this company. Sumitomo Chemicals has been a company that we own for a good part of 1.5 years. We continue to remain optimistic on this. It's a B2B agri-chemicals manufacturer company with a 75% holding from the parent, which is a Japanese company. So they continue to insource molecules from an R&D perspective at the parent, and Sumitomo Chemicals manufactures at a pan-India distribution level for the Indian entity, along with selling for the global entity for the R&D that comes out of the parent. Bata India, we owned Bata. For investors who've been with us for a while, you would have seen Bata from 2017. We exited in 19, and we actually got in again 8 months back when there was a change in management. Bata is actually revamping its product portfolio as a result of that. And you're seeing when the channel checks that we do on the ground, when we visit some of these franchises and stores, gives us conviction that they are actually positioning themselves for the new age, as well as transitioning into an e-commerce led growth as well, and which is validated from the numbers that on the ground. Sera is a sanitary ware company, and it's a real estate ancillary business the way I call it. So effectively, it's the house is constructed is when you actually think about sanitary ware as a requirement for your home. And again, it's a zero net debt company. It's grown its cash flows from a fairly robust perspective. And whatever has happened from a supply chain perspective, Sera has been a beneficiary because it's one of the few companies in India which doesn't rely on imports for its manufacturing. Most of its manufacturing is actually done because the management has supply chain backward integrated it quite a while ago. Infosys is again a position that we've been holding for a while, and which is again, it's a company that continues to do well with the IT and digitization theme going on. And the kind of contracts that Infosys is winning is at a scale that it has not seen before in the last 20 years. From a detractors perspective, first position CAMS. CAMS obviously did well post the IPO. Then over the last 6 to 8 months, there was pressure as one of their anchor investors who've been invested in CAM since 2012 trimmed down their stake. So there was some noise on that. And secondly, they are venturing into reinvesting capital into some interesting spaces, account aggregator being one. So how they execute, how is the monetization going to turn out, along with the fact that their core business continues to grow at north of 12.5, 13% in line with the mutual fund industry growth. We continue to believe this is a space that we would want to own over the next 3 to 5 years from a management perspective, as well as how they've optimized their balance sheet. FS in e-commerce is Nykaa. I had explained the core thesis of Nykaa in the previous call. We've actually done multiple webinars around why and we think we would want to be monitoring the B2B execution, which is where we feel there is huge amount of value, well, and B2B is what they are entering. And one of the recent hires that they made, and in fact, it's interesting because 4 months back when we spoke, roughly around 3 months back when we spoke about Nykaa, we compared the B2B execution potential of Nykaa with Udaan. And lo and behold, they actually make a hire someone who basically headed the B2B of Udaan is now looking at coming in and running their B2B channel for Nykaa as well. So it's interesting to see how they execute. HDFC Life, life insurer company, we best in class in terms of VNB margins, in terms of growth, how they manage the business. We've held this for a while. It's done well for us. We trimmed this position somewhere around mid last year. So the drag is more of on the smaller size that we own. Nazara Technologies is a gaming infrastructure platform company. And today, Manish Jain as a CEO is redeploying the capital that the core business is generating into acquisitions, into building a network of gaming companies where there is significant synergies along the ground. So we're excited. There is a lot of risk in terms of gaming and in terms of how it can scale. But once when you study the fact of how gaming scales from a US or a Korea or a Europe perspective, you will see the kind of potential scale that this can actually bring to the table. And there is a lot of work that we do in the private market space as well, because the kind of capital that is going into gaming in the private market is unheard of as far as India is concerned. The position size will always be small because we are dealing with India, where there is always a regulatory headwind that to deal with. Fino Payments Bank is again a small position. This is a payments bank. What it does is effectively a micro ATM. So small merchants in outskirts of tier 1 or tier 2 and tier 3, the merchants effectively become a bank for people to do their remittances through a device that Fino provides. So you can think of it today. I don't know how many of you go to an ATM, but the last time you go to an ATM, it is a nightmare, right? The concept of a bank for an ATM is a loss-making franchise for a bank. You talk to any bank, you will realize that no one wants to expand ATMs, but they will expand branches, but they don't like the unit economics cost of an ATM. So as you make merchants a bank, you have remittances, which is payments, along with micro ATMs, which is used for withdrawals. Each of it is actually charged. And now, once you have a network which is basically bringing the unbanked into bank, there is no credit risk in this because doesn't lend. They now also have started opening CASA and cross-selling products into this channel. So it's an interesting space. And this has been a detractor since the IPO. I want to briefly cover that as well. So in terms of our investment strategy, I wanted to spend some time around explaining what our investment strategy and philosophy has always been and continues to be. So there are only 3 levers to our strategy, and this is the basis for each of our investment decisions that we make. So when we review our portfolio, what we are doing, an investor should continue to benchmark us with regard to the consistency of our strategy across cycles and market conditions. So for us, the first and the most important lever is to continue to focus on companies which generate cash flows and grow them. Why? Because these are the kind of businesses that do not dilute their balance sheets for growth. What do I mean by that? So generally, when you want to grow your business, you either dilute equity or generate cash flows, have growth, or during difficult situations when the during that. And hence the concept of downside protection, which we always emphasize, becomes that much more important. Second, cash flow growth is history, right? When a company does that, it's an interesting company. That doesn't mean that you as an investor will benefit just because you invest in every cash flow growth company. And that's where focusing on reinvestment of those cash flows in order to measure what is the return on incremental capital becomes that much more important, right? So for us, what we are looking at is how is the management or the promoter family reinvesting that. They could do it in the core business. They could start doing it in unrelated diversification, which is what begins to start worrying us. Or they could look at expanding capex, which is what analyst community hates because that would depress the earnings. But we like it because they are then investing for the long term. Finally, we don't want to overpay. So I always emphasize this: every business has a price at which you want to own it. It does not make sense to buy a business at any price with the hope of buying quality. That's not the narrative that makes money. Anyone who's managed money will tell you that valuations matter, and we continue to believe that valuations matter. Right. Finally, the last point is what I always want to emphasize, which is risk management. It's important to understand businesses change. Why do businesses change? Because people change, which is what evaluating the management constantly becomes extremely important. Hence, risk management has been a key ingredient of what we focus at ITIS, right? How do you as investors measure that? We have never been a buy, hold, and forget investor. I'll never come to you, or none of my team members will come to you and say that we bought this business. This is a great business. Hold it for the next 10 years, we'll make money. Never. Right? We evaluate businesses constantly, and when there is a course correction needed, be it in terms of trimming risk or in terms of exiting a position, you would see us do that. How do you as investors measure and monitor that? In terms of what we report in the form of a churn rate, where we also cover our exits and the rationale, and that's historically been 20% on a year-on-year basis, and that's what you should expect. Now, to the return metrics, right? So many people ask us, okay, you're an active manager, there is now passive fund, there are a variety of funds available to us. Why should we look at ITIS, right? So I spoke to you about the process. Now let me just translate that process in the form of numbers, right? So I spoke to you about cash flow growth. I spoke to you about return on incremental capital and not overpaying for the business. So if you look at our historical portfolio metrics around the numbers that matter and the numbers that can easily be monitored as for you as investors, the simplest numbers are incremental equity, which is basically your ROIC or ROC. It's a small difference, but for sake of simplicity, I've put down ROC out here. With your operating margins. Operating margins tell you the pricing power of a business, right? Remove out any expenses and costs. You can look at it from an EBIT margin perspective and calculate operating margins. So if you look at why have we outperformed Nifty, right? Because for an investor today who looks at ITIS, okay, 5 years is great. That doesn't mean that how do I get the comfort that it is the ability from a process perspective to continue to do that over the next 3 to 5 years cycle. It's predominantly because of the numbers that I'm representing, right? Our return on incremental capital, with regard constantly higher than the index. In many cases, our operating margins has always been almost double that of the index, right? So the reason you should expect us to outperform the index over 3-year cycles, which is what I explained earlier in the presentation, is predominantly because of this. So it's not because we are doing magic or there is no process. The process translates into numbers that we care about, and that translates into the outperformance, which is why I wanted to highlight that. The next part of the presentation is to explain to you around the concept of rotation, right? And this is where, why have you underperformed in the last 3 months or 6 months? The reason is not because a process changed. The reason is because the way market, what do I mean by that, right? So in the first part of the table, which I put, which has been mentioned in dark gray, right? So we are comparing Itus into some of the sectors that we would look at. So the concept of cash flow growth and incremental capital lends itself into a certain set of sectors that naturally fit in, which happens to be either private sector banks, or it could be IT biotech, it could be pharma, it could be B2B manufacturing, it could be consumption, right? And it also does not lend itself into certain set of sectors that don't have these characteristics, which is basically your commodities, your metals, your PSU banks, and infrastructure kind of companies, right? So when you look at the last 6 months and 1 year, what have the sectors that lend itself into the ITIS's way of investing done versus what has the sectors that does not lend itself into the ITIS's way of investing done is important to highlight, right? So especially when you look at it over the last 6 months, where we've done negative 2.8%, right? You look at where have the returns in the last 6 months come from. It's come from a lot of cyclicals. It's come from metals. It's come from energy. It's come from paper. It's come from sugar. It's come from infrastructure. So generally, for us, these are not businesses that lend itself into our process. Why? Because from a longer term perspective, I'll just come to it, they don't give you incremental returns. You might have the ability to time, you might have the ability to trade, but it doesn't fit into our process of investing, right? So we want to continue to focus on our process and ensure that just because the market rewards a certain set of sectors through the price, you would not see us chasing them because it doesn't fit into our process. Now, how do I explain this concept into what happens? So I just explain this concept from a 6 months and a 1 year perspective. Let's look at the same concept from a rolling 3-year perspective, right? So again, what we have done is on the table above, you will see ITIS's fund returns against the sectors that you would see us investing into. And the table below talks about those sectors, which I just told you had great 6 months and 1 year returns, versus how the same rolling returns pan out as you hold these businesses for the next 3 years, right? So, for example, we just spoke about this in the 2017, 18, and 19, right? So, when you look at the average 3-year cumulative returns, ITIS has stood at around 78%, going anywhere between. So, IT has had a great last 3 years, but anywhere between 16% from pharma all the way up to 59.5% at Nifty, right? So that's where our outperformance has come from, and that comes from security selection. Because out here, I'm just covering, because many people like to ask the question, which sectors do you choose, or which sectors are you invested in? While we don't like to think of it that way, it's important to understand when you ask that question, what are you actually asking? You are asking what is our process, and that lends itself into a certain sector. And now coming into what I call cyclicals, here again, you look at the 2019 3-year rolling returns, right? It looks fabulous. Why? Because of the last 1 year returns that I spoke to you about. But if you then take a 3-year rolling return across cycles, many of these sectors have either been value destructive or they've compounded like at 7 to 8%, which is more like slightly over FD returns. And hence, when I tell you it does not have a carrot or return on incremental, that's what I mean. They tend to destroy capital over time. So for investors who think they have the ability to time, they are great places to trade. Not for us as fund managers, because it doesn't make sense to go into such sectors hoping for something new that will happen, right? So you can always go through cycles between 2000 and 2020. Someone can say that now we are like 2003, where the PSU banks did very well, or commodities did very well, or cyclicals did very well. And if you go into the highest bull market that India has ever seen, which is roughly between 04 and 07, that ended badly too, right? So this is a place that you would not see us investing in at its very core, predominantly for these characteristics. So final thoughts before we open up the floor for Q&A. Roughly, I would say portfolio health to us continues to be at the best shape since inception, which is what I spoke to you about the metrics and how it's evolved over time. And why has that happened? It's predominantly because in the last 3 years, you've been hit with COVID, you've been hit with war, you've been hit with macro event. And these are the kind of businesses whose pricing power increases, whose ability to reinvest increases because they have a large potential market that they're going after. And these are the pockets that you would see us wanting to be in, right? So all of these disruptions and macro risk, when we ask ourselves the question, what do you think about the market? For us internally at Itus, me and my analyst team, when we sit down, we are not thinking about the market. We're thinking about individual companies around those who have the metrics and the positioning that I just spoke to you about. And that's where you would see us allocating capital. In India, we have all the indicators for that. We really need to do something really bad to screw this up, because you have supply chain coming into India. People need to realize this, right? Not because we are the most efficient economy today. It's because of all of these supply chain disruptions that have happened at a global level, right? If 4 years back, if I had spoken to you, and I speak to a lot of people at Apple on the West Coast as well, and they said, would you set up your plant in India? They would laugh. Today, one of the largest manufacturing plants of Apple and iPhone production happens out of Tamil Nadu, right? It is unheard of for Apple to do that. And I can go on in terms of, let's talk about Foxconn, right? Foxconn and Taiwan have been like, that's the home. For Foxconn to come and set up a manufacturing plant in India 4 years back would have been unheard of. But today they are not left with a choice, they have to do it, right? So there's a big tailwind for India that will play out on the next 3 to 5 years, and in my mind, longer. That doesn't mean you're not going to have volatility, right? So the only way you measure volatility and we manage volatility is by investing in businesses that protect you during these downsides. So finally, before opening it up in terms of Q&A, I just want to leave you with a parting thought, right? So Michael Burry is a legendary investor. He was one of the investors who actually made close to $5 billion in the Great Depression in 2008. And this was from a book that we were reading, and we thought this snippet basically summarizes what does borrowing conviction mean, and how does each investor need to have their own process and stick to the process in order to bring consistency, because there are different consistent process of investing in cash flow growth and return on incremental capital. And this highlights what he was talking about around why it's been very difficult to copy Buffett and why he himself evolved a strategy over time. So I just wanted to leave you with this note before we open up the floor to questions.
Thank you, Naveen, for the update. Participants who have questions can now type in your questions in the chat button. The questions are visible only to the panelists. The participants can now type in their questions. Naveen, I have a question. So we have HDFC Bank in our portfolio. With the merger of HDFC Bank and HDFC Limited, how does this merger impact the stock, and what are your views?
Sure. So I think we've been, so me as an analyst, even before ITIS, I've been tracking and talking to the management for a good part of 10 years now, right? I can safely tell you that under Aditya Puri, this would not have happened, though someone like KK Mistry always wanted this to happen, right? So are we surprised by this happening? Not really. But the timing of this is always something that I think about, because and I'll come to it, right? First, from a numbers perspective, I think the analyst community at large has already laid out the thesis saying that this is going to be incrementally positive for the bank, because now HDFC Limited's cost of capital is going to reduce. The reason they did not do it from a commercial perspective few years back, leaving aside Aditya Puri, is the fact that there was a regulatory arbitrage that you could play with the kind of PSL, as well as the PSL numbers in terms of what you set aside for the CRR and SLR. And that regulatory arbitrage is no longer relevant based on the RBI regulations. Hence, you can now merge the limited, which predominantly lends its core product as a single product. It lends to individual investors who borrow on for property or loan against property or developer financing. That's pretty much the product portfolio. So there is a huge untapped portion of the market that you can sell into as you cross sell your products, right? So from a numbers perspective, there is some amount of efficiency to be gained over time. Now, the thing that we think about is all of this is Excel sheet modeling. It's great. Now, if I happen to be in Shashi's shoes, I think he has a lot on his plate to already transition the bank from where they are from a technology perspective versus where they need to be, which is what they are reinvesting in. So on top of this, now you need to deal with the integration, which is not going to be that straightforward apart from what you see in Excel sheet, right? Because if you talk to the core culture and employees of HDFC Limited, it is at least our belief that they are very different from the culture of HDFC Bank. So that culture integration cannot be modeled on Excel sheets. So to us, while I don't think it is supremely optimistic like the analyst community makes out, we would want to see how the culture integration happens, because there are synergies to be exploited, but it's going to take some time. So there is a view in the market that this is a great time to keep building into the portfolio. We would want to take a slightly more cautious stance towards it and not add risk because of this merger. That's the way we think about it.
Thank you, Naveen, for that. Naveen, this question comes over and over again. Why are we compared against the Nifty and not the Nifty 500?
Sure. So I explained this briefly in the call around consistency, around drawdowns, around why Nifty 50 continues to be the best performing index. But I've always said this, if anyone wants us to compare. So we internally, as Ajit is aware, put down the metrics on a basis of comparison with Nifty 50, along with Nifty mid, along with Nifty small, along with Nifty multi-cap. So if anyone wants to see it, we are happy to send it across. All I can safely tell you is our returns will stand out even better when you compare it with any of the indices. The day it doesn't, I will be the first person to highlight it to you, right? The reason we are continuing to show it to you against Nifty 50 from the time we started, it continues to be the hardest index to beat. So we can always show it against mid, small, or multi and look better, which we are happy to do. But we feel it is only rational for us to compare it against the best index that's been performing well in India for as far as we are concerned. But Ajit, whoever is asking that question, what we could do is email them offline around the comparison that I just spoke to you about, and they can look at it for themselves.
Sure. I mean, what is your view on ITC?
So I think we've covered this. Obviously, we don't hold ITC in the portfolio as a PMS stock across all clients. So the view is that we don't hold it for a reason. right? So the reason that we don't hold it is, again, let me just now take you through ITC from the three lenses that I spoke to you about, and then say why we don't own it, right? So does ITC generate cash flow growth? The answer is yes, right? The cigarettes business, come what may, will continue to generate cash flow growth for ITC. The problem for ITC is the reinvestment that the management continues to do and deploy funds in the hotel business. And they are not going to stop doing that. That has always been EBITDA negative. That has dragged the returns. And that's where our concern has been. In terms of valuation, it is super cheap, right? There's no two ways of mincing that words. But it's super cheap because they don't acknowledge, or they continue to sidestep that question around why do they want to continue to redeploy into the hotels when their FMCG business is beginning to show signs of operational leverage. Now, I think roughly around 3 to 4 months back, somewhere around that time, they did a call with the analyst community and the retail investors at large, right? Because the shareholders of ITC are predominantly retail investors. And they did a 720-page presentation, which went over 7 hours, explaining their strategy. Now, when a company does things like this, I begin to worry, right? Because from a capital allocation perspective, there are only 3 things that you need to do, which is what I laid out. The day I see them doing that, we will change our mind. Till then, it doesn't fit into the process the way I laid it out to you. So that's our view on ITC.
Okay, thank you, Naveen. So, Naveen, what would be the churn percentage in the portfolio for the last 3 years?
Ajit, so we can come back. So since inception has been 20% annualized, right? That's over 5 years. If it is over last 3 years, maybe we can, if you could, we'll come back to the person and measuring it over just the last 3 years and break it down for them.
Sure, done. If there is a 300 to 400 basis points hike by Fed, how would the market behave?
So I think people can write what they want, right? So this is where, this is the reason I generally don't like to discuss macro, because if there are 3 people discussing macro on the table, there are 5 views that come out, right? But if there are 3 people that are discussing micro, it really doesn't go beyond a single view at best, maybe 2 views at best, right? So it's always easier to discuss micro because you have things under your control and you understand what is happening, versus macro where you're never in control, right? But having said that, let me answer this question because this is my view, and please caveat it saying it's just a view and I would be free to change it from time to time. So let's look at the benefit of history for people, because people forget history. In the last 11 years, where US has gone through the biggest bull market decade that US has had since inception of the equity markets in the US, right? In 2013, Fed initiated a rate hike cycle where they hiked over 4 quarters, which is when the media, the analyst community, and the smart economists said QE is coming to an end. 2017 again, the Fed initiated a rate hike cycle over 3-4 quarters, where again we said QE2, QE, every QE is coming to an end. And each of these hikes, the Fed has had some macro event to deal with, which they have resorted by answering through easy liquidity. Now they have inflated their balance sheet. They have taken it to an astronomical level that I would certainly not want to be in the Fed's shoes. And now they are saying they need to increase their rates by 300 basis points. I don't think they have the bandwidth to increase the rates by 300 basis points. I think US has the ability to get into a recession if they do it, because the demand cycle is not great. So I think there is an issue when people say that, because that's the language and people react to the language. You've seen this play out over and over again. I think you have the borderline possibility of a US recession if they do it. And for Indian investors, is that point of concern? When you study recessions over the last 24 years in the US, every time there's been a US recession, India has outperformed. So no matter how we look at it from a macro perspective, I see India benefiting. In the short term, yes, you might see risks. in the 3-year cycle that I speak about, that I urge investors to think about, you will see India outperforming. That's my view from a macro basis.
Thank you, Naveen, for that. Your view on the chemical sector, do you feel the sector is richly valued?
I think the sector is certainly richly valued, right? I mean, any sector that grows at a sector level, right? I'm not talking about a company level. At a sector level, grows cash flows at an annualized rate of 24%, which is unheard of over 7 years, will be richly valued. So when a sector displays that level of consistency, it means it is associated with a certain trend that is happening. And obviously, when you look back, you understand what that trend is, right? There is a China plus one story playing out in a significant level. China is not going into the chemical space aggressively because of the pollutants involved, as a result of which the Indian supply chain has benefited massively. Now, the question at these high supply levels and the volume expansion that most of the companies have done, and you see that with the new IPOs also in this space, is now you now have to deal with a company specific problem rather than a sector problem. So the answer to your question is it is richly valued, but are there pockets of opportunity at a company level? I still believe yes.
I mean, with exposure in IT and pharma, with rupee depreciation, what is your call?
So again, right, I think the cash flow growth for IT and pharma doesn't come because of rupee depreciation. It gets enhanced because of rupee depreciation. Here again, I have a counter thesis that I don't expect the rupee to depreciate from here. In fact, I will put up my hand and be the first person to tell you in an open forum, I expect the rupee to appreciate from here. Right now, does that mean that I have to change my view on IT and pharma? No. Right. Infosys over the last 10 years has not compounded capital, or TCS has not compounded capital because the INR has depreciated 100% in the last 10 years. They've compounded capital because structurally, the kind of contracts that they are winning and the digitization contracts that they are winning has grown and is been at scale. Now, the only thing that I would like to highlight is pharma is a very, very diverse sector. Within pharma, there are 4 subsectors that behave very, very differently. Right? It's important to understand this. The first subsector within pharma is the domestic generic pharma, which has gotten hurt and which will continue to struggle, in my view and in our view, because of the distributor consolidation and the lack of pricing power from a US perspective. Then is the branded generics. The branded generics where you have licenses of IP where you can brand it for a certain period. You have certain beneficiaries of that in the product portfolio, like Sun Pharma has a fairly strong branded generic portfolio. That part of the portfolio should benefit within pharma. It has nothing to do with depreciation, by the way. I'm just talking about pharma. Third is the domestic API manufacturing businesses, which we like. But the caveat being the businesses that we like are backward integrated from a supply chain. So they have better handle of the costs and they have better handle of the manufacturing processes. And the fourth subsector is the domestic API manufacturing, which rely on China for the key starting material because they don't have backward integration in place. And this, there is always been a key risk. It has played out in the last 6 months. We've not wanted to own such businesses, and our view doesn't change one bit, right? So I think when people look at pharma and say pharma is going to benefit, I think people need to start identifying what they are talking about pharma rather than just saying pharma is going to benefit. So that's the first thing that I want investors to differentiate. And the second thing is, I think we own certain businesses because they are structural in nature, where we see supply expansion benefiting these companies. We've never owned them because we have a view on currency depreciation or appreciation, and that continues to be our thought process.
Thank you, Naveen, for that. I have another question. The cash flow growth, when you look at it, is it actual or it is projected growth?
So there are 2 aspects to cash flow growth, right? One is how has the company historically managed and generated cash flows? There are certain sectors that lend itself to generating cash flows, and there are certain sectors that don't lend itself to generating cash flows, which is what I spoke to you about. All of this is historical. Now, we as investors don't get paid for what happened historically. It is just to understand what kind of a business you are dealing with. We as investors get paid for how the company continues to execute in the future, which is where there is uncertainty. So when we value a business, we don't come out. So when we look at a target price, the concept of a target price in our mind is utter rubbish, right? Because how can you put a price on a business which is growing? All you can do is to create scenarios. What is your bear case growth? Which means if you get it completely wrong, what is your growth? And what is the implied cash flows as a result of which? And how do you do a present value of all of those cash flows? What is your base case growth in a normalized world? And what is your bull case growth? We as analysts, when we invest in a business, we invest in those businesses where we don't lose much in a bear case growth scenario, right? So for example, let's take a company called Syngene, which we've held since November 2017. We've not sold a single share of Syngene till now as we speak, and we continue to add to the business. The historical cash flow growth was 23%. In the last 5 years that we held it, the cash flow growth is 22%. And from here, in a bear case scenario of a 10% cash flow growth, we don't expect to lose more than 15% on this business. And hence, you look at that business being fairly significantly weighted in our old portfolios and also having a decent weight in our new portfolios. So for us, what we are doing is understanding how much can we lose when we get it wrong, rather than saying how much can we make when we get it right. Because as these businesses continue to compound, your IRRs will anyway come to you. That has never been a problem. The question is, how do you minimize your downside when you get it wrong? So when we project, we are talking about projections in different scenarios and how do we minimize the downside, and that's how we manage our risk exposures.
Thank you, Naveen. So I have one last question. With India becoming the supply chain of the world, do capital good companies deserve a closer look?
So I think India is still early stages. That's the narrative. I don't think all the supply chains are moving. So it's important to understand that India is a beneficiary of the supply chain, not because we have best in cost labor and efficiency. We are doing it because of some of the macro events that have hit companies that they didn't anticipate over the last 20 years, right? So if India has to become the supply chain hub, then we need to have labor margins along with efficiency margins in comparison with China, where I think we are significantly lagging yet, right? So I don't think we are anywhere close to that. There's still a long way to go for that. So there are certain pockets that are getting benefited, as a result of which India is a beneficiary. Now, capital goods certainly has been a beneficiary of that, right? A lot of good quality capital goods companies that have benefited as a result of it. Now, the problem with capital goods businesses from a structural perspective is the incremental capital in terms of returns has never been there, right? So they actually display more cyclicality. I'll give you a simple example. The best in class company in India, one of the best in class, not the best in class, but one of the best in class companies is a company called Bosch that everyone has heard of. And every one of us in the call today may have used a Bosch product. You need to go back in history over the last 15 years or 10 years or last 5-year cycle and just evaluate Bosch IRR. It's not been great. The reason is not because it's not a great brand and it's not a great company. The reason is because the reinvestment cycle in terms of the opportunity set has not been great. So if you can time the capital goods cycle, I think you can make money. We would be slightly more cautious from our process around the kind of companies that we look at in this space, but it certainly deserves a merit, sure.
So thank you for it. I have one last question. Would you look to invest in airlines and higher stocks?
Airlines and?
Hotel stocks, hospitality.
So the entire point of me making a statement on ITC was why we would not invest in ITC is because it is going into a capital inefficient sector, right? I think these are businesses that you can trade. There is a reason that you see bankruptcies in this sector way often than normal, right? And I think I'm not saying investors should not, but since the question is pointed, you would not see us investing in a hotel stock, nor would you see us investing in a airline stock, because both of this will not pass our first filter in itself of generating cash flow growth. And when we don't find that, you predominantly see these businesses expand through debt, which is what I spoke to you about capital allocation. And when you see that, then you have to have a favorable demand cycle for you to make money. So that's not the kind of businesses we invest in.
Okay, Naveen. Thank you for that. Would be it.
Yeah, thank you, Naveen, for all the answers. And it was so insightful. And Ajit, for taking up the Q&A. Once again, I would like to thank each one of you for taking the time and for your patience on the call. So the recording of this webinar will be sent out once it's made available. I wish you all a wonderful weekend and have a great time.